Hello and welcome to smarthelping.com. Today we've got an e-commerce financial model. It is super robust. I'm going to walk you through all the assumptions in every tab so you see how it works, and hopefully this will be helpful to a lot of people. So let's just start with the control tab. So here's where you're going to control the timing. First cell here is actually really important, and you need to put in the year that you plan on the financial model starting. It has nothing to do with the date or the month, so just put 1/1 and then whatever year you're starting. And then the model will go out for 5 years, and starting at that year. You can do an exit month if applicable, or just hit NA if you don't plan on exiting the business or don't want to see that cash effect, or you could pick any month to stop. And at that month, it'll stop everything, give you an exit value based on a multiple of the trailing 12-month sales, and that will flow through the model. Next are cash sources. So this is if you're getting any loans or debt, taking on debt like from a bank, standard P&I repayment here. If not, you can just zero it out. And then based on your assumptions of startup costs and any negative burn, you'll have some equity that needs to be required. And this is going to come from either the investors or the owners or some combination. So that's the total. You could put in how much you plan on raising from investors, how much of the company you're going to give away for that. There's an implied valuation based on those numbers, and then any remaining cash, if there is any, will come down to owner requirement, equity requirement. Now this could be zero if you raise, let's say we raised, 300,000. That's just about enough. 325. Then it's saying, the owners have no equity requirements, but they are getting 60% of the profits. And then debt and equity down here is just some math on how much equity you got versus debt. Let's say this was 100,000. This was 100,000. Now it's almost even, 30, 30, 30. But those will be based on your specific situation. Next up are revenue assumptions. This is the nuts and bolts of the model. This is really the most important part. So this is how you're going to start and grow your revenue. I've done it by 10 types. So let's say you're an e-commerce business, you might only have type 1 might only be relevant. So you just need one row for the entire model, and that's fine. You can just zero out everything that doesn't matter just by clearing it. But I did up to 10 types so you can plan out, let's say you had 10 different um, products you wanted to sell online, and they were varying in prices and you wanted to see the granular difference between all those, you can drive it by that and see all the the P&L detail and everything by item type. Um, Also, let's say you had thousands of products, but you wanted to group them into categories. This is also good for doing that, and you can just put average sales price for the categories. So it's just important for modeling. If you want flexibility, you need to have granularity like this. So that's why it's there. But again, you could just use one row if that's all that matters. So the first section of this is determining the price of each category. This is how much you're selling it for to customers. This does not include sales tax. So sales tax is likely something that goes on top of this. Consumer pays it, and then you just remit it to the relevant government agencies. But for the purpose of the model, sales tax is not included in the price here or in any of the costs, because it's basically a wash. Whatever sales tax is there, it goes up, it goes on it, and then that comes right off. Now, if you are including sales tax in this final price, then it would be you would have to have some cost there, which would be hard because you'd have to do it in the operating expense assumptions. But for the model, you should be putting in the sales price before sales tax if you want an accurate P&L. Next up is ad spend. So this is the first main revenue driver, It could be relevant to you. It might not be. If it's not, you can zero out the entire thing. If it is relevant to you, then great. What you will do is the start month that you plan on spending money on ads for each type here. It could all be the same month, all different, doesn't matter. And then how much you plan on spending by month in each of the 5 years. So like $10,000 a month in year one, $10,001. And I'm just putting random numbers here so I can check the math, make sure all the logic works. Oh, that's something else I should mention. All these assumptions are arbitrary. You will use this template as basically a blank slate, and you will put in numbers that make sense for you. None of these numbers mean anything at all. They're just I put them in here so I can check all the logic and make sure the math and everything is working and all the references. But let's just say you have $10,000 a month in year one. Let's say what's your cost per sale down here, because you need to know how many sales this is going to generate, and then based on your sales price, how much revenue. So if you put $25 here, that means you spend 10,000. Every sale costs 25. So simple math, you do 10 divided by 20, 10,000 divided by 25. It's essentially saying you're generating 400 sales. And then if the price of type 1 is $39, that's 15,000. Now you can see if your price point is below your cost per sale, you're going to lose money. Let's say this was $24. Well, now I'm making 96, but I'm spending 10,000 on ads, so I'm losing money. So that's how that all works and how you can think about that. Put that back to 39. So that's the first way you can drive revenue. The second way is with partners. So you could have affiliates or however you want to set up the programs, but you have partners that go out there and make sales. You have a certain amount of partners per category type, and then the partners you have in each category type have a different start month or the same, but you can define their start month. And then I put in a monthly growth of each of partners in each category. So you can say, well, I start with 2 partners for this type, and those partners grow at 3% per month in year 1, 2, 3, 4, and 5. And you can change these to whatever. And then that will drive how many partners you have. And then down below, you can define the average expected sales per partner for each of these type 1 through 10. So here it's saying, well, you got 2 partners in this one. They sell 1 unit a month in year 1, 2 units per month in year 2, 3, 4, and 5. So this is allowing you to show like more efficiency in your programs, better growth of partner sales, and growth in the amount of partners as well. So that's another big way that e-commerce sales are driven. It might not be relevant to you. If not, again, you can zero all this out, no problem. And then the final sales driver is just organic sales. So this could be people going to the website because they know your brand, just clicking in the domain, word of mouth, all those different things. And this is where it's going to be hard to estimate this, but you can just define some amount of organic sales you think you'll start with, and then how much you think those sales will grow by month in each of the 5 years. Now, some people will just have a model that just basically does this. You define your sales, how much those sales grow, and what's your price per unit, and that's it. But I wanted to get super granular here and be very clear and have some advanced logic to put in partner revenues and ad spend revenue because I think those are heavily used in the space, and I think that logic will make modeling a lot more accurate, or at least you'll be able to put in assumptions that you can kind of that's just more granular. Okay, so that's your revenue drivers. If we go to expense assumptions, this is pretty much the same as I have in all my models. You've got your sales and marketing, if applicable, again, zero anything out. This is the monthly cost in each of the years. You can put the start month of each cost type as well, and that will affect the model. We just did sales and marketing, general administrative costs, and research and development costs. So if you want to see, let's look at founder and CTO. Let's say they started in April 2021 at $5,000 a month. Let's go to the monthly detail. Find that cost. Let's see, that was, I think, R&D, or yeah, CTO. So you can see there in April, it's dynamic, $5,000 a month. Let's say we change that to July. If you go back over here, now we're starting in July. So all that logic works all the way down through all the costs. Um, if you're wondering about payroll tax and benefits, you would need to include that in this monthly amount. So let's say their salary they're getting paid is 100,000. Well, they get 100,000, but you also have to have payroll taxes and benefits that may be included in that number. So you want to add that on top of it and put that in here because there's no other place to put payroll taxes and benefits. You need to actually put it into their monthly cost here. Oh, and then, okay, so here we have, I did a little bit of logic for any cost directly related to revenue. Essentially, the biggest thing that would apply here is credit card fees, but there could be other stuff. Also, if your credit card fee, let's say half of your revenue is paid through credit cards. Well, if the credit card fee is 2%, but only half of your customers pay it, then essentially you would put 1% here to get to the right number. Um, and again, you can pick the start month of this as well. When we go to average commission rate for affiliate partners, that's saying these partners here that we're driving, you have to pay them something for all the sales that they're getting. So this is defining the percentage of the total sale that you're paying these partners, which could be different on each item type. It could be the same, or you might not pay them anything, put 0%, or if they don't exist, then you can zero all that out. Finally, the last cost area is cost of goods sold. So this is like if you're doing e-commerce where you're drop shipping and you have to buy the product and then sell it. Well, you've got your sales price defined over in the revenue, but you have some cost that goes along with each sale. So here you'd put the average cost per unit of each type of item sold. And again, that might not be applicable if you're selling a digital product or something that just doesn't have a direct cost of goods sold. That's completely fine. Again, zero it out, and that will be no problem. Okay, so if we're looking at the monthly P&L detail, essentially everything I just went over in the revenue and expense assumptions is this top, this defining all the sales, sales by ad spend, the count of partners, sales count from partners, sales count from organic, and then the revenue from each of those accordingly. And then we have our expenses, cost of goods sold. This is what we just talked about with like the drop shipping or something. Sales and marketing, um, partner commissions. That's that 40% we had in there. The ad spend, general administrative expenses, research and development. You see all this how it flows with the assumptions in the order that those happen. I wanted to look at one thing here real quick. So the revenue on here we have to start month for function of totally monthly revenue. Now the start month won't matter. It shouldn't matter unless for whatever reason something doesn't need to start as soon as revenues start. Then you would want to put it later. Otherwise, you can just leave these as the first month of your forecast. Let's go to that part real quick. So yeah, so that is looking at that. So you can adjust the start month, but in general, it should just be whenever revenues are starting, that's going to hit. As you can see, it's just taking the total revenue times whatever rate is in that. It's indexing the rate for each year. Okay, perfect. Next up, we have startup and CAPEX. So here you've got one-time startup costs. This is something that's like happening before you actually begin operations. So creating a website, you might have consultancy fees. You might want to put a reserve in here just In general, that means that um, assuming your assumptions happen exactly like you think, um, and you do need, um, and you're not making you don't have a positive cash flow from the start, meaning you need cash, some amount of cash. When that goes to zero, you'll actually have 200,000 in reserve. Whatever you put in here, and you can see we default down here to understand when we actually hit zero cash flow, and that's based on the minimum cash, um, based on all the burn and all the startup costs. You have some minimum cash position, and then the debt and investor proceeds will zero out or are automatically input to make sure this hits zero and no lower or no greater. And all that means is um, you're only this is only getting you just enough equity to um, survive. But if you put in a reserve here, essentially you're actually having enough equity to get down to this 200,000, and that's your buffer. Now you can put any number here, and it'll all flow through. Like let's say I wanted $1 million buffer. Well, now if I go over the control, you can see, well, now I need 884,000 from owners to get to that minimum, and I'm still at zero here. This is basically when I start making money, and then there it goes. Let's undo that. And then we have CAPEX. So these are like one-time expenditures. We're not getting into depreciation or taxes in this model at all. You could, if you wanted to try and plan out taxes, you could put taxes in the expense assumptions under general administrative and just estimate what you think they're going to be each year. But e-commerce in general, depreciation is not a huge thing. I mean, it obviously depends on exactly what you're doing, but in the most cases, which what I'm trying to model is to fit most cases, you're not going to have to worry about depreciation. If you did, you could pick a line and put depreciation in there, but you would have to make sure in your P&L detail and annual detail, and in the executive summary, you have to make sure that you're taking that out in your um, in your cash flow, like or adding that back into the cash flow because it's not really a cash item. And then the only reason you do that is because you're doing capital expenditures that are depreciable. Um, but again, with e-commerce, that's not. I mean, most cases are not going to deal with any of that, or the capex items will be directly expensable and not have to be on a depreciation schedule. The only point of this is just to say or plan out one-time uh, one-time events in the future that you just need to show cash coming out for some reason. That's all this logic is doing. Essentially, it's the same as startup costs, but some point in the future that are separate from operating expenses. Okay, so then let's get into our summary tab. So we have the executive summary. It shows an annual amount of unit sales, revenues, cost of goods sold, gross profit, profit margins, your main expense categories, total expenses, resulting EBITDA, debt service coverage, which is only going to be relevant if you have debt. If not, then it won't. Annual EBITDA per active user. So this is actually average EBITDA per sale. So you make 56,000 sales, $175,000 in EBITDA. You're actually making $3 in EBITDA per sale. We'll put per. Okay, and then we've got other cash items here that all affect the cash flow after equity, and then cash position. I have, and we'll get into this in distributions, but essentially you've got the project internal rate of return, equity required, cash projected cash return, equity multiple, ROI, and it does that for the project as a whole, and then for the investor and the owner separately. And the IRR is always, for the project, is always going to be in between the investor and owner's IRR if you have investors. Now, charts revenue versus EBITDA, pretty simple. Yearly unit sales here. I got a little, I've never done these kind of diamond medallion type things for the um, each year's data labels, but I thought that was kind of nice. So I put that in there. Unit sales. We have distributions. So this is actually, and let me put this back to NA so it looks a bit cleaner. So this is showing you the project's cash flow based on how much equity is needed up front, and then what cash flows remain after that, and then how it's split to the, um, well, this is actually a um, discounted cash flow analysis. So we're discounting that on the project level, showing the net present value of the project. Also, the investor and owner have their cash flows, their internal rate of return, and their discounted cash flow analysis and net present values as well. We've got a nice chart here showing the cash flows for investors and owners. And if you don't have, if you just have one group that's funding this, then it'll just basically be the project will be the same as whatever it is, the investor or the owner. Now this up here is actually really advanced, and it took me a while to figure out the best way to do this. But this is because we're assuming all equity needed for the project is up front. So if there's let's say a cash burn in the future, and that cash burn is either going to be included in this initial upfront equity that was required. If that has all been used, then the cash outlay will deduct from the any positive cash flows for that year, and then that will give you your resulting cash flow. And that's just so you don't double count any revenue or basically any positive cash flow months, or not count a negative cash flow month, because this is showing you all your positive months added together, all your negatives, and then this is the startup equity needed. So that negative, those negatives are going to be paid for in part. But let's say in year 3 or 4, you could have a negative month with cash flow, and if you're just looking at positive cash flow months, you won't actually capture that negative month. But here you will dynamically, and it all works automatically, so you don't really think about it. But that's kind of what's going on here, and it's the only way I could figure out it doing it this way that would make sense and give you proper and accurate figures here without double counting or missing anything. That's happened. Then we have visuals, so annual revenue, gross profit, EBITDA, monthly revenue versus sales count, average revenue per sale, monthly sales count by type, monthly revenue by type, annual revenue by type stacked. So you can see this is actually just over 7 million, which is what your revenue is here, just over 7 million. But it's essentially each of these bars of total revenue are now broken down into each type. So ad spend, partners, and organic. And you can see that breakdown by doing it like this. Monthly cash flow. You can kind of see when you're breaking even. This is the cash flow before any equity contribution. So Um, basically, you can see when the equity is paid back is when this goes positive. Um, average monthly revenue per partner, monthly ad spend, and I did a ad spend margin. So this is like this analysis here, the ad spend is doing exactly what I showed you here, where you're like you've got a price, you've got the spend, the cost per sale. This is showing you if you're profitable or not based on whatever your inputs are, which the profit would be this number here. So revenue, cost, and then the middle one is profit, which is just this one minus this one. And then you could also see that what the margin is in this dotted line. Total partners, just a regular line chart, annual gross profit margin, and annual cost analysis. So this is taking your total costs, which would be this. Let's see, did we do a total cost one? We might not have. Total revenue. Nope, I think this is it. So this is just adding up all of the costs together, sales and marketing, G&A, cost of goods sold, R&D is in here. It's really small, but showing you the total amount of those and then what it's broken down into. All right. And then I guess that's basically it. The monthly detail is just this is the how everything is working, and this is where all your assumptions go to so that we can figure out the result of them. And we have to break it out into all these different things so we can see it. But this is just getting down into EBITDA, cash flow, all your advanced metrics here on a monthly basis. The annual tab is doing the exact same thing as the monthly, but just on an annual basis. I did collapse bars here so you can kind of hit the number one button at the top left here, and it will collapse everything so you can see just the high level, which is useful if you just want to quickly see different items and without looking at their details. Debt schedule is just a regular amortization schedule. You can put in the assumptions for it here. Oh, let's make these blue. Um, and then this is sourced from the control tab. And that's pretty much it. So if you're looking to get into the e-commerce game, or you have an existing business that you kind of you're planning on doing some investments and see what happens, and you want a 5-year plan for that, you can also use this to do that. Now for purchase, if you want this template, the link will be in the description box below. You can go over to that, and I haven't decided on the price. I think I'm gonna do $75 for it, which is intermediate level. And I'm also gonna list it on Eloquence and eFinancial Models. One thing I did want to show you if I could, let me try to open up another browser real quick. So on Smart Helping, I just put in some new bulk discounts as well if you want multiple templates of different categories or all of my templates. Let me just try and bring that up real quick. Come on. There it is. And I apologize if you're on another vendor site, then you don't need to watch this. But if you're interested, I have put in some bulk orders. Here I just adjusted the pricing. So you can buy 5 mid-level, 10 mid-level, all mid-levels. And the mid-level, intermediate, upper tier doesn't really apply to the necessarily the advanced, if the model's advanced or not, but it's just what I think it should be priced at. So there's plenty of mid-level models that are more advanced than upper tiers, but there might be an upper tier because I think it doesn't have as much demand, but whoever does see it will probably buy it. So the upper tier intermediate just refers to the price. It doesn't refer to the actual um, necessarily the actual ability of the model to do things. Um, you can buy all the upper tiers, all the intermediate, or all the models for these bulk prices. I'm also thinking about, and I've done it by category as well here, and this will show each category, what's in each category. And the one I just did, e-commerce is going to go into the industry specific financial models right here. But what I was thinking about doing, and you could give me feedback, is I don't know if it'd be useful to say, like here I did 5 and 10 mid levels and then all mid level. Would it be useful to you guys to have maybe half, like get half the mid level models? You can just tell me which ones you want, or half all the intermediate ones, half all the upper tier ones, and just for basically half of what this bulk price is. So 250, 130, and 225. And you can see the count of each here. There's 12 upper tier, 7 intermediate, 84 mid-level. There's going to be 80. Well, there's going to be another one added. I don't know if it's going to be 75 or 45. But all right, that's all I got for you. I'll see you on the next one.